Joe, I want to come over to you. Looking at some of the market's moves this week, a lot of people said, well, it's profit taking. People are just taking some profits. But people don't take profits when they think the market's going to keep going up. So have we seen a significant change in sentiment?
Well, no, wait a second. It can be profit taking, but that profit taking could be motivated by some catalyst that you're seeing in the marketplace. I think one of those catalysts... But
wouldn't it be a negative catalyst that would make you take the profits?
Oh, of course it would be a negative catalyst, but I think one of those catalysts really relate to Friday's Jackson Hole speech. I do believe that Chairman Powell, there's a high probability that his words are not in rhythm with the market expectation, which is pricing in nearly an 80% cut in September. So I think you're ultimately going to get a reluctant cut. So what's happening within the market the last several days is very clear. You are seeing what was the leading factor in the market, the momentum factor. That's where the profit taking is unfolding. And it's interesting because really what unfolded in the first part of August is you had this dramatic acceleration in the momentum factor. It was driven by names like Palantir. Not surprisingly, Palantir peaked on August 12th. The following day, the momentum factor peaked on August 13th. So a lot of those momentum names, you're seeing that there is I want to call it a temporary top. It could be a permanent top. Let's not hope that it is. But there could be certainly an inflection point in the second week of August. In addition to that, I think what's important is we had the rebalance for our ETF at the end of July, and what we witnessed with a lot of the momentum names that we entered, they have not worked out. We entered software names like Datadog, even Microsoft, Cadence Design. They're all down. Datadog's down 10% since we entered that. Microsoft's down 5%. We entered a bunch of crypto names like Coinbase. That's down dramatically. Block is down as well. So what we were doing, we were recognizing Q2's momentum, kind of going with it. But guess what? That's a false breakout. What that really represents is exhaustion in the marketplace, and that puts you where you are today, where you have this exhaustion element that's leading to a modest correction in the market, driven largely by where the strength of the market has been year to date, the momentum names.
All right, we certainly see a slowdown when it comes to momentum. I don't know if you guys covered this on halftime this week, Joe, if you were here earlier. Evercore ISI's Julian Emanuel came out with a note saying, Kerry, I'm talking to you about this. If we see a neutral or a slightly hawkish Jay Powell, we could see a 7 to 15% pullback in the markets. I just got off the phone with him. He believes we're already seeing that pullback start right now as more and more investors believe that we are going to see at least a neutral or hawkish Jay Powell. Do you agree with that sentiment? That some of this action is basically front-running with the expectations of Jay Powell at Jackson Hole on Friday?
Well, I don't think we're going to see a very dovish Jay Powell. So that's just a fact. He has been data-driven, and since the data combines inflation, which isn't going down, and job growth, which of course seems to be falling, he can't be all in one way or the other. So, I would take that off the table. I would say it's the second half of August also. So people are on vacation. We have sort of flatlining in the market or malaise in the market because people have seen this enormous spike since April 8th. There's a little chart we put together that shows that since April 8th, the bottom, the NASDAQ composite is up 40%. Not 5, not 10, not 20, 40%. NASDAQ 100 up 37%. S&P 500 29%. Even the equal weight, which doesn't have, of course, the huge mega caps driving it ahead, up 22%. So sure, it's time to take some profits. That's not profits of a little bit. It's profits like 80%, 90%, 100% in some names. Makes perfect sense for the market to do that, in our opinion.
All right, so you're saying basically it's somewhat exhaustion.
Yeah.
You've had huge run-ups from those April lows following the quote-unquote Liberation Day tariffs. Yeah. And the market's run up, and to Joe's point, the momentum has slowed down a bit. People want to take some profits off the table.
And vacation, and some vacation.
Vacation, and it is August here on Wall Street, and all fairness, Spring coming over to you. Also want to get your take on some of the action we're seeing in the market. Something else to point out, and I was looking at this earlier. If you look at our CNBC Market Strategist survey, our team does a great job. Michael Bloom, the rest of the team at Pro. The median target for the S&P is 6,500. That's about a 2% increase from where we are right now. The average is basically where we are today. So, when you look at the institutional side, at least, there doesn't seem to be a lot of optimism for us to go up from this point anyway.
Well, we'll see how we get there. But I think looking at 2018, which once again was when Trump really leaned in on the China tariffs, who spoiled the party? It was newly elected Jay Powell thought that inflation was going to ramp up again and started becoming hawkish at almost the exact same time as we're having this today. And I wholeheartedly agree with Joe and Carrie. I think exhaustion is a very important word to use. Gravity is, once again, you can't have a Palantir or these types of companies just going at this huge angle upward, way over their even 10 and 20-day moving averages. You just have to have that come down. And I think that when you look at the data that's come out, CPI was a really good number. But once again, the tariff components don't penetrate through CPI. They absolutely show themselves in PPI. And if you look historically, this a higher PPI are those companies and those industries that are showing those inflationary signs because the tariff's going to ultimately push those through to the consumer. And I think that's what's going to be difficult about Powell going into Jackson Hole. So I agree with Carrie. I do not think he's going to be dovish. And so I just do think we have a setup between seasonality, Jay Powell once again looking for the data to confirm we're not going to get what we're asking for. And so that could set up for a little bit of a pullback. But I don't think it'll be meaningful. And I continue to think people will buy the dip because of all of the stimulative effect of the big, beautiful bill that's coming into the economy.
All right. Bryn, 2 points to the seasonality. September of the last 10 years has been the worst month of the S&P. Average decline of 2%. So I get you on seasonality, but I want to go back to CPI. You said it was much better than expected. I mean, headline was a little cooler than expected. Core was a little bit hotter, and it didn't really show that very clear trend of downward inflation. I was actually talking to Roger Ferguson, former Fed Vice Chair, about that today. I mean, he agreed. It wasn't that great of a CPI, and it was a very bad PPI if you're someone that wants a rate cut. So when you put those two together, I mean, it seems like Jay Powell.
Right.
No,
what
please,
I was saying is that the components of tariffs do not populate through CPI. And so CPI is, below 3%, right? And Powell's been very clear. We don't need to see inflation at 2. It needs to be going in the right direction. So when you looked at CPI, we all got excited, right? To say, oh, tariffs are not having an impact on inflation because the components don't go into that. Owner equivalent rents has nothing to do with tariffs. PPI, it does though. And so what I'm saying is that Powell has this juxtaposition of PPI is showing you that tariffs are having an impact. The CPI doesn't. And so I think that you will continue to see a more hawkish Jay Powell because the PPI to me is the more relevant number when it comes to looking at the tariff impact.
All right, so after the PPI is when you had the adjustment, and that's where the market had to begin to kind of recalibrate towards what we're all speaking about, which is this reluctant cut that might be coming. It's not going to be a forceful 2024 Jay Powell that's going to speak about, okay, we're going to pivot away from focusing on inflation. Now we're going to focus on the labor market, and most likely in September we're going to cut rates. That's a very clear message to the market. This message, I think, is going to be a message where he's going to be on both sides of the fence. And I think the market is going to have a degree of difficulty with that. By the way, I don't think your premise is that in order to buy risk, you need rate cuts. I think the premise on if a rate cut happens is, does it finally allow the opportunity for the long-awaited broadening out, not just on a cyclical basis, but on a more prolonged time frame? That's really the portfolio reallocation that is going to be most impacted if, in fact, you get the beginning or the restart on cutting rates once again.
So it sounds like when you keep saying reluctant. So 50's off the table, 25 is a maybe, and even if it happens, Carrie, you're nodding right now. It's reluctant.
You're getting 25, but it's
probable.
In September.
I think you're getting 25, and there's no guarantee you're getting another 25 later in the fall.
No,
maybe not until 2026 is what you're saying.
I mean, the market would be extremely surprised if there was a rate cut of more than 25 basis points now.
Well,
I mean, no
it would be
one's
surprised now, but before PPI, there was bubbling up murmurs.
Well, I mean, we've heard a lot from the White House how important it is, how it's necessary. I mean, there's been a lot of talk about it. It hasn't come from Jay Powell, right?
Sure.
And this market believes there's going to be 25 reluctant, but that's probably the right thing given the labor market is softening. But, with the type of rally that we've had, particularly in the big cap names, this is just understandable. I think it's healthy. it's reasonable. And, let's not forget, people keep talking about how strong earnings have been this quarter. What was strong were about 6 companies' earnings this quarter.